Hey everyone, welcome back to Corporate Decoder, the place where we unmask the financial secrets hidden in plain sight, especially when it comes to big changes in company loans. You won't believe how much this company just expanded its borrowing power. Today we're diving into a filing from Overland Advantage, and it's all about a major update to their credit agreement. Think of it like getting a much bigger credit card with better terms, and it's a pretty big deal for how they can operate and grow. So, what exactly happened? Overland Advantage, or the company as they call it, just signed a Sixth Amendment to their revolving credit agreement. This sounds fancy, but it simply means they made some significant changes to a contract that allows them to borrow money. The credit facility itself is with Sumitomo Mitsui Trust Bank, Limited, New York Branch, and NatWest Markets PLC. This Sixth Amendment is pretty packed with important updates. First off, they've added something called uncommitted facility tranche mechanics. Now, don't let the jargon scare you. What this means is they've opened the door to borrow up to an additional $500 million. This is on top of the money they could already borrow, which was $200 million for revolving loans and another $200 million for term loans. So when you add it all up, the total potential borrowing capacity for Overland Advantage has jumped to a massive $900 million. That's a huge increase and tells us they are planning some pretty significant activities that will require substantial funding. This could be for expansion, acquisitions, or just to have a larger safety net for their operations, beyond just how much they can borrow. They've also improved the terms of the borrowing. This is where things get really interesting for making and spending money. For loans tied to something called term SOFR, which is a common benchmark for interest rates, the cost of borrowing has gone down. For revolving loans, the interest rate dropped from 2.25% to 1.75%. That's a half a percentage point drop, which might sound small, but on hundreds of millions of dollars, it adds up to significant savings. They also managed to lower the rates for loans based on the alternate base rate, dropping it from 1.25% to 0.75%. Again, these are savings that directly impact the company's bottom line, freeing up cash that would otherwise go to interest payments. But perhaps one of the most crucial changes is the extension of the maturity date. This is the deadline by which the company must repay the loans. They've pushed this back from July of 2026 to April of 2027. This gives them more breathing room, more time before they need to worry about repaying the principal amount of the loan. This is vital for long-term planning and allows them to focus on the business rather than immediate debt repayment concerns. Now, it's worth noting that Overland Advantage is marked as an emerging growth company. This means they have certain flexibilities under regulations. They've elected not to use the extended transition period for new or revised financial accounting standards, which means they'll adopt new accounting rules faster than some other emerging companies. While this isn't directly about the loan, it suggests a proactive approach to financial reporting and compliance. And that's the core of this filing. It's an update to a really important financial agreement that gives this company a lot more flexibility and financial power. They've increased their borrowing capacity significantly and secured better terms on their loans, extending the repayment deadline. This Sixth Amendment to the revolving credit agreement is officially filed as Exhibit 10.1. They've also included the standard cover page interactive data file. The asterisk next to Exhibit 10.1 means that some supporting documents or schedules have been omitted for brevity, but the company will provide them to the SEC if requested. Looking at this from a higher level, Overland Advantage is clearly making a strategic move. By securing a larger credit facility with more favorable terms and an extended maturity date, they are positioning themselves for growth. This means they likely have ambitious plans that require more capital than they had access to before. The reduction in interest rates is a direct financial benefit, increasing profitability over time. The extended maturity date provides crucial operational flexibility, allowing them to invest in projects without the immediate pressure of significant debt principal repayment. The fact that they are an emerging growth company and choosing to adopt new accounting standards more quickly suggests a commitment to transparency and a forward-looking financial strategy. This kind of proactive stance can build investor confidence. In terms of risks and opportunities, the increased borrowing capacity is a massive opportunity. They can now pursue larger projects, acquire other companies, or weather economic downturns more effectively. The primary risk, of course, is that they may take on too much debt or that the investments made with this new capital do not yield the expected returns. However, the improved terms suggest they have good standing with their lenders, which is a positive sign. Ultimately, Overland Advantage is signaling a period of potential expansion and strategic investment. They've engineered a more robust financial foundation to support these ambitions. It will be fascinating to watch how they deploy this increased borrowing power in the coming months and years. Alright, that is our breakdown of Overland Advantage's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think expanding their debt is a smart move? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps, and subscribe for more deep dives and to get these insights directly to you. Don't forget to check out the Discord community linked in the description below to continue the conversation. Thanks for watching. See you next time.